You know, for so many people, owning a home is the American dream. But let's be honest, anyone who's actually bought a house knows it feels like you're climbing a mountain of paperwork. Well, it turns out that dream comes with this really detailed rule book, one that's been written and rewritten for almost 100 years. So today, we're going to pull back the curtain and figure out how this whole system came to be. I mean, this is the question, right? Why is it so complicated? Why are there so many forms, so many disclosures, all that tiny fine print? And the answer isn't just, oh, it's bureaucracy. It's actually history. Here's the thing. To really get why your mortgage works the way it does today, we have to go back in time and look at the problems we were trying to fix yesterday. All right, so here's our game plan for this explainer. We're going to start with the basic rules of the dream. Then we'll dive into how the foundation was built. After that, we'll talk about the all-important right to know for consumers. Then we'll hit the big one, the crisis that changed everything. And we'll wrap it all up by talking about what this actually means for you. Okay, let's jump right in. The first big idea to get your head around is this. The whole mortgage process you go through today, it wasn't just invented overnight. Nope, this thing was built piece by piece over decades. And I mean that literally. Every single form you sign, every disclosure you get in that giant stack of papers, it's all part of this massive story. Think of each rule as a response to a huge historical event. We're talking about the Great Depression, the Civil Rights Movement, the rise of the internet, and of course, that massive financial crisis. Each one left its mark. So where did it all begin? Well, we have to go way back. Our story really kicks off during a time of incredible economic pain, which is when the government decided it had to step in and make homeownership a real possibility for way more people. And check out this timeline. It really shows you that first huge wave of change. It all starts in the 30s with the FHA. Then you get Fannie Mae, which was created to keep the money moving through the system. Fast forward to the 60s, and bam, things get even bigger with the creation of HUD and two absolute game changers, the Fair Housing Act and the Truth in Lending Act. Okay, so before 1934, getting a mortgage was, well, it was really hard. You needed a massive down payment, and you had to pay it back super fast. It was basically a system for the rich. But the FHA completely changed the game. By insuring the loans, the government basically told lenders, hey, don't worry. If the borrower can't pay, we've got your back. This took a ton of risk away from the banks, and suddenly they were way more willing to lend money. This is what paved the way for the 30-year fixed-rate mortgage that we all know today. Okay, this next one is a big one, and you really have to understand the context here. The Fair Housing Act wasn't just another financial rule. No way. This was a monumental piece of civil rights legislation. It made it flat out illegal to discriminate against someone trying to buy a house because of their race, religion, or where they came from. The whole point was to make sure the American dream was truly for everyone. This law went right after some truly awful practices. Take redlining. Lenders would literally take a map, draw a red line around a neighborhood, usually a minority neighborhood, and just refuse to give out any loans there, period. It also banned steering, which is when real estate agents would guide people towards or away from certain areas based on their race. So yeah, this law wasn't just about money, it was about justice. All right, so after setting up those foundational rules for access and basic fairness, the focus of the government started to shift. The new mission? To arm you, the consumer, with information. It became all about your right to know what's going on. The 70s ushered in this giant wave of new regulations. People call it the alphabet soup of laws, and you can see why. FCRA, ECOA, RUSPA, HMA, it's a lot. But the idea was simple. Just saying don't discriminate wasn't enough. We needed rules to actually enforce that fairness. These laws were all about transparency, giving you rights over your own data and your application. And that theme of transparency carried right on through into the internet age, with laws about data privacy and e-signatures. So, ECOA basically took the baton from the Fair Housing Act and ran with it. It broadened the protections, making it illegal for any lender to discriminate based on things like your gender or if you were married. Think about this. Before ECOA, a lender could ask a woman if she was planning to have kids and use that to deny her a loan. After ECOA, that was illegal. The only thing that was supposed to matter was one simple question: can you pay the money back? And this idea was boosted by other laws, like the Community Reinvestment Act, which basically told banks you have to serve everyone in your community, which was a direct shot at fixing the damage from redlining. You know when you go online to get your free credit report? Well, you have the FCRA to thank for that. This is the law that says you have a right to see what the credit bureaus are saying about you. And this is so important, it gives you the right to challenge any mistakes you find. Your credit score is obviously a huge deal when you're trying to get a mortgage, so making sure it's accurate is a massive protection for you. So then, of course, the world went digital. And with that came a whole new worry. What about our data privacy? That's where the Gramm-Leach-Bliley Act, or GLBA, comes in. It's the reason your bank and your mortgage company have to tell you how they share your info and why they have to have a plan to keep all your sensitive data safe. And just a year later, the eSign Act made digital signatures legally binding, which is what really opened the door for the online mortgage applications that are so common now. So for decades, this whole system of laws just kept growing and changing. But then 2008 happened. The system was put under this incredible stress test, and some parts of it just broke spectacularly. The financial crisis that followed set off the biggest wave of new rules and regulations that we've seen in our lifetimes. And just look at how fast everything changed after that. It was like a firestorm of new laws. You had the SAFE Act, professionalized the industry, then the monster Dodd-Frank Act created a brand new agency to protect consumers, and then came new rules like TRID, designed to make those confusing forms a lot simpler. Every single one of these was a direct reaction to what went wrong in 2008. And this chart really just shows you the night and day difference. Before 2008, you could get something called a stated income loan. You basically just told the bank how much you made, and they often didn't even check. It sounds wild now, right? Well, after the crisis, we got the ability to repay rule. Now lenders have to do their homework and make sure you can actually afford the loan. And all those really risky types of mortgages got replaced with safer, more stable loans called qualified mortgages. So, one of the huge problems before the crash was that pretty much anyone could be a loan officer. The standards were all over the place. The SAFE Act put a stop to that. It said, nope, from now on, if you're going to help someone get a mortgage, you need to get educated, you need to pass a test, and you need to get a license. It basically turned it into a real profession, all to protect you. But really, the Dodd-Frank Act was the big one. I mean, this law was enormous. It changed practically everything. But the most important thing it did for you and me was create the Consumer Financial Protection Bureau, the CFPB. Think of it like a new sheriff in town, but one whose their only job, was to protect regular people in the world of finance. They were put in charge of writing the new rulebook and making sure banks followed it. Okay, so we've gone on this huge historical journey, right? We've covered almost a century of laws and crises and reforms. So what's the bottom line? What does all of this history actually mean for you today when you're filling out that mortgage application? Let's just take one simple example, the loan estimate form you get at the beginning of the process. It used to be that you'd get two different forms that were super confusing thanks to older laws like TILA and RESPA. Well, the Dodd-Frank Act basically said, this is nuts. We have to make this simpler. So it ordered up a new combined form. That led to the TRID rule, which created the much clearer loan estimate and closing disclosure we use today. So that one single document you hold in your hands, it's the end product of 40 years of trial and error. And that's really the whole point. Look, I know the paperwork can feel like a total nightmare, but every single piece is there for a reason. It's a shield. It's why a lender has to prove you can actually afford the loan. It's why you get that clear breakdown of costs up front. It's why you have to show all that ID, which is a holdover from the Patriot Act. It all weaves together to create a system that's trying to do three things: be transparent, be fair, and keep the whole housing market from falling apart. So this entire system was built over 90 years, always reacting to the problems of the past. But the story's not over, not by a long shot. With new technology and new challenges always popping up, the system is going to keep changing. Which leaves us with a really big question. What new problems will the next decade of rules have to solve?